Hi James, hi Steve. Thank you for joining me to review how the funds are positioned moving into 2026. Steve, do you want to start by explaining how the fixed income allocations have changed?
Yeah, sure. So one of the most influential decisions we made on the fixed income side is to reduce our exposure to the riskier end of the corporate bond market, what people like me would call the high yield bonds or sub-investment grade bonds. They've had a really good run this last few years, performed really strongly. So we're doing it from a position of strength. But the problem with really strong performance in the market for high yield bonds is it compresses the extra return that you get from high yield bonds as compared to government bonds. Government bonds contain very little default risk, whereas high yield bonds contain quite a lot. So you really want to be compensated for that extra risk. And we just feel after this period of strong performance, we're less compensated than ideally we would like. So we've reduced our exposure there, and that exposure has moved into government bonds where the same sort of problems don't persist. We're still pretty positive on government bonds, though, on the corporate bond market more generally, because we think we're going to get some more interest rate reductions.
And James, have there been any changes to equity allocations?
They have, yes. So throughout last year, equity markets did particularly well, albeit they weren't absent of volatility in asset prices. But what we did see during the latter part of the year was a broadening out of equity market leadership. So the US led the way for the first half. Those equity market returns really broadened out at both regional level and the sector level during the second half. So in terms of allocation changes during the last quarter, we've increased exposure to UK equities within the VT Greystone funds. Now that is focused in larger businesses with more globally diversified earning streams. So it really means we've got less sensitivity or limited sensitivity to the UK specific economic conditions. If we turn to our US equity exposure within the funds, we've taken profit on a number of underlying holdings and rotated those proceeds into a broader set of defensive elements across the components. So that's utilities, sector exposure, healthcare, consumer staples. And these are really elements that will shore up the portfolios if we see further equity market weakness throughout this year.
So outside of the UK and the US, where else are we allocated?
We have sizable exposure across Europe. We like a diversified approach across the continent, so large cap or small cap in terms of the size of the businesses that we're exposed to, and also at the industry level, taking a broad approach there. Elsewhere, you've got the likes of Japan and emerging markets. So with Japan, we've got a new prime minister, their inflation looks to be under control. There's corporate reforms going on. So we're quite positive about the region, what that will do long term for asset prices. And then with the emerging market space, we like to be quite selective in terms of our exposure. We have holdings in Indian equities. Now they have had perhaps not the greatest of starts to 2026. They did well throughout 2025. But in terms of the valuations, what investors are being asked to pay to have ownership within an Indian company, they're quite rich valuations. Asset prices within global equities have flowed more towards the AI, the tech story. So in the short term, Indian equities have been volatile. We think it's quite a good entry point for us in the VT funds. In terms of the long-term growth story in India, we still think that that holds up. Increasing domestic incomes, good demographic. So long term, it's a positive story for India.
Okay, thanks for that. And do we have any specific commodities holdings?
Yes, well, we continue to hold a small, reasonable allocation to gold and also silver. That gives us a degree of protection against possible inflationary pressures and also continued geopolitical tensions throughout the course of the year. So in summary, our positioning is one of long-term opportunities with increased resilience for short-term bouts of geopolitical risks.
Okay, thanks for that, James, and thanks, Steve. And thank you to our investors for your continued support.